shares of Shopify are down big today, almost 19%. So the company reported earnings, but analysts weren't thrilled with the forecast. So let's take a deep look at why the stock is doing badly today and if it's worth investing in it right now. So you can see it's plummeting because its second quarter revenue growth isn't as good as what analysts were expecting. So in terms of its recent earnings numbers, however, adjusted earnings beat expectations, so 20 cents versus 17 cents. But the big problem is that they're spending a lot on marketing to help fuel its growth. But if we look at the forecast, so Shopify said revenue is going to grow at high teens compared to a year ago, but analysts were expecting about 19%. So how far off of a difference that is, I mean, it's debatable, but doesn't look like it's a huge difference. But nonetheless, any sort of miss sometimes on Wall Street is cause for a sell-off sometimes. So the company also said gross margins are still expected to decrease slightly. So again, some margin compression. That's obviously not a good sign to see that, just because that means those profits are going to be harder to generate. So those are the main reasons in terms of growth, the forecast. Let's take a look at the actual financials themselves. So here I've got Shopify's most recent filing, and if we look at their revenue, so we can see subscription solutions were up from 382 to 511, merchant solutions from 1126 to 1350. Overall, 1.86 million USD versus 1.5. So some good growth there. Gross profit also increased, so that was good. Sales and marketing expenses were increasing. R&D actually went down. General admin was flat. Transactions and loan losses slightly up, but overall operating expenses actually went down, even though the company generated more revenues. That's a good sign for the company. And what's really positive is that its operating income was a positive 86 million versus a loss of 193 million a year ago. So the adjusted earnings numbers reflect adjustments to net income, net loss. So in this case, Shopify actually had a net loss of 273 million versus a profit of 68 million a year ago. Now that may look bad, but realistically, it's due mainly to its losses on equities and investments. So obviously the equity markets have been a bit worse this year versus this time last year. So Shopify's lost 373 million on that versus a gain of 215. So it can be a bit misleading if you're looking just at net income, because this is going to include a lot of noise like equity investments, gains and losses. Like here we got foreign exchange, obviously not significant, but the big one is those stock gains and losses. Like if I do a search for 373 on its financials, we can see that had an unrealized loss on equity and other investments of 373 million, which included 351 million unrealized loss in investments with readily determinable fair value. So probably talking about stocks there. So basically they had a big loss on their investments versus a year ago, where they benefited from a gain. So in that case, it flipped a loss into a profit. But the more important number, I'd argue, is this operating income, because at 871 86 versus a negative 193, that's a positive sign that the company is getting leaner. It's improving on its profitability. The company's growing, and the fact that they're growing and their operating expenses are actually coming down, that's a really good sign for a company, especially in tech and e-commerce, where their expenses may be accelerating. So even with spending more on marketing and things like that, it's still a pretty good result in that case. So I wouldn't spend too much time worrying about the actual net loss number, because again, that's due to equities and other stuff. The actual day-to-day business operations look pretty solid in terms of their income, their operating income of positive 86 million. Now, another important thing to look at is the statement of cash flow, because this will tell you if the company's burning money, then it's going to have to raise stock, and that's dilutive. That's bad news for shareholders. So 3-month period, we're looking at 238 million versus 100 million. Another really good sign. Now, the one thing you always want to look at as well is stock-based compensation, because these are expenses that if they were cash, obviously they'd have an adverse impact on the cash flow. So it's important to factor that out as well. So A quarter ago, they had 100 million, but 135 of that was stock-based comp. So if that was cash, this actually would have been a negative. It would have been a cash burn of 35 million. Whereas here, stock-based comp of only 105, even if you take that out of this 238, it's still positive. So that's another really good sign that Shopify is doing well in terms of having a more sustainable operations, generating positive cash flow from its day-to-day operations. Its operating income is also positive, and it's still growing its business. So, I mean, if its growth rate slows down a little bit, I mean, that's really not the worst thing in the world, because right now the economy is not in the greatest shape right now. People worried about a recession, job losses, and things like that. So the fact that it's still doing well, it's tightened up its financials, and it's turning out a profit, is generating positive cash flow. Those are really strong positives. So today, the stock, if we look at it, let's pull up the actual ticker here. So if we look at the stock now at 62.73 on the NYSE, so we can see that's down to about where it was in October of last year, and this is levels it was at when it was selling off in early 2022. So it's a decent stock to buy right now. A lot of focus is going to be on those growth prospects, but in the end, in the long run, Shopify is still doing well. It's still growing its business, and once the economy improves, once there's a better outlook for the future, that growth rate will improve, and the company will be in much better shape. So I think it's definitely a good buying opportunity right now on this dip, just because the financials really aren't that bad. And the sell-off is really just due to, an underwhelming guidance. But high teens versus 19%, I mean, that's not really a huge enough difference to say, okay, that the business is in trouble, because it's generating positive cash flow. Its operating income is positive, so it's going in the right direction. So that's a good sign in the long run. So I think this sell-off could be a good opportunity for people to buy the stock now.